Hello, welcome to the Paper Podcast. I'm your host, Ryan James. I'm excited today. We've got Kian Sarreshteh. He's the CEO of CryptoFi. Now, we're going to go over in this episode what a custodian is, what a liquidity provider is, and how CryptoFi works and navigates in order to offer your customers best of class purchases for cryptocurrency in your native online and mobile banking.
Cash rules everything around us. Money is a tool, it shouldn't confound us. We show you the do's and don'ts, the ins and outs. The financial world is changing, we give you the roadmap. When you follow the paper, watch your paper stack. With innovative thinking that's sure to have an impact. We give facts, cause the more you know will help you navigate this road and avoid potholes.
Hello and welcome today to the Paper Podcast. Today I'm excited. I've got Kian Sarreshteh. He is CEO of CryptoFi, and Kian has been in the IT fintech landscape since 2011. He was business development VP of a startup called SaveUp in 2015, and in 2016 he acquired a background checking company that focused on regulated industries such as nuclear and financial services, where he led and built blockchain native database to store records. And then later in 2019, he co-founded CryptoFi, which provides cryptocurrency services to banks, credit union, and other financial related companies. Kian, welcome. How are you doing today?
I'm doing well. Thanks for having me. Excited to be here.
Yeah, me as well. I'm excited seeing what CryptoFi is building right out now. You know, from our previous conversations, everything that you guys are doing is right in line with what we're thinking and where banks should be in the future for offering cryptocurrencies. Tell me about CryptoFi and what you guys are doing.
It's been a very interesting journey, having came from, like you mentioned, the first fintech startup that I did was a traditional, call it maybe a banking style startup where our primary client base was credit unions. And so, since then did a lot more in the crypto native blockchain world. And then, like you said, in 2019, having started CryptoFi, really, with the mindset of merging those two worlds together. And, early on, I had the realization that the traditional banking world and the crypto world, it just could not be more different. And, I think that was what was exciting to me at the time is, I saw the challenge of what was going to be ahead of us in terms of needing to really marry these two ecosystems together. And, that's been an interesting road over the last few years. And where we're at now, I think it's a lot different than where it was even a year ago. I mean, the first 6 months when we started this was really just ideation and really trying to figure out, how we could deliver cryptocurrency services to a heavily regulated bank, for example, and getting the right pieces in place from a technology standpoint, from a liquidity standpoint, which I'm sure we'll talk about today. And also from a compliance standpoint, of course, was incredibly challenging. So it took us a while before we even started building. And then really wasn't until maybe middle of 2021 when we started to actually socialize our initial product, which I guess I'll talk about briefly. So,
yeah.
So it makes sense here. But yeah, our initial product that we built, and we were one of the first, and even the last year we saw some new entrants into the space. But we built a cryptocurrency product that integrated with existing digital banking providers. So any bank that was using any of the digital banking providers that we're integrated with, such as Q2, Alchemy, Bano, and a number of others that we're talking to right now as well, could easily turn on a user experience to allow banking customers to buy, sell, and hold cryptocurrency from existing web and mobile apps. And really the approach that we took was to replicate an experience that the banking customers were already getting on third-party platforms. A lot of the bankers that we
So you're looking for customers once they're in existing online banking and mobile on their banking site to be able to purchase cryptocurrency seamlessly.
Exactly. And
how did the bankers during the ideology? How were the bankers receptive to this?
At first they weren't at all. And there was a few moments where we had to have some pretty deep conversations internally about, is this a path that we want to continue down? But I think everyone here had so much conviction that, Web3 is going to be coming to banking sooner than later that we continued on. So, I mean, yeah, at the beginning, no one had wanted to do, had, 2020, no one wanted anything to do with cryptocurrency, as a banker. And, it's crazy how fast the space moved, because just in like a 12-month period, it went from being this very scary topic to something that a lot of bankers were studying. We talked to a lot of banks that were actually studying the capital flight that was leaving their bank and going to these third-party platforms. And what they started to notice was these third-party platforms that were originally just crypto were now crypto and banking. And so the writing was really on the wall, and it still is on the wall.
So was that why they changed their tune within a year?
That is my thesis. Yes. And of course, no one has came out and told me that was the reason why, but part of my job was trying to make sure that the banks understood that they were losing customers, they were losing deposits. And, once a customer transfers their funds over to, using Robinhood as an example, because I think they were one of the first crypto platforms to actually launch and of course, Robinhood started as a stock trading platform, but once they launched crypto, shortly after, they launched their debit card and their checking account. And so, you started to see some of these banking products come into play with Robinhood. And then you see companies like SoFi launch crypto. And of course, SoFi competes directly with banks for all the lending products. And so once a customer transfers funds over to SoFi, for example, why do they need to get a loan with the bank? Why can't they just use SoFi? And so I think that's
so. Are you seeing just the larger regional banks, or seeing banks of all sizes now interested in cryptocurrency?
I think it's really banks of all sizes, and it's interesting how crypto has become more of a priority, I think, for a lot of the bigger banks in particular, who have more resources to be able to study it, understand it. I think part of the value that we provide to some of the smaller regional banks is the education aspect of it, because a lot of them, I mean, even today, everyone's knowledge is really all over the place with crypto, as you can probably imagine. And, even today, you talk to some community bankers that don't even know, what crypto is. So you have to start there, and then educating them on, why it's something that they should seriously be considering now. And because it's all over the news, I think we're starting to get more attention of bankers now than we did, say 2 years ago. So,
and I'm seeing more of it at banking conferences, but I still see it very limited to a couple companies that are offering through the banking channels. And now I see some of the bankers are, the fear of missing out, and they want to jump on board. And we need to get into, what banks need to ask when they're looking to add this to their online banking, because, as far as I'm concerned as a bank, you need to not add this to your product mix just to check a box. You need to actively pursue it. You need to monitor it, and you need to have it very fluid in your online banking and your mobile app banking. So, your customers can easily purchase it. They know what they're doing. It's displayed well. You've got all the compliance aspects in. They know it is not guaranteed. It is not insured, and go from there. But let's start from the beginning. I mean, I'd like to assume that audience understands, what cryptocurrency is, or even if they don't, they at least know that, their customers are buying cryptocurrency and they're storing it and they're using it to store value and to purchase product services.
Yep.
So, what are the, what should banks be asking? Yeah.
So having a long-term strategy in place, I think is really important. I think I see a lot of banks scrambling just to turn on a crypto solution so they can compete. And, some of them I don't think are really, and it's really not to anyone. It's not their own fault for not having the big picture in mind. But if you don't come from the world of crypto, then you don't really know what's possible and what's coming. And so what we try to do is educate them on what you need now, and then what you need to start thinking about and planning for the future, because the crypto providers or vendors that you're working with today may not be best equipped to make sure that you're best positioned to compete now and in the future, right? So that's what we try and help educate bankers on is the core building blocks to any crypto solution, or at least any retail crypto solution now, is the buy, sell, hold use case, right? Offering, like you're saying, offering a way for their customers to seamlessly purchase crypto directly from their checking or maybe savings accounts in their existing digital banking environments. And then once you actually buy that crypto, there's a lot more that you can do with it. And the roadmap that we have is one that's going to position bankers to remain competitive from that core buy, sell, hold use case, and then also lead into some of the more interesting and more advanced use cases, like you mentioned, payments. So if you want to unpack some of that more, we'd be happy to. But
let's do that. So let's start. You got banking customer that's in their online banking, and they're looking to purchase, $100 worth of Bitcoin.
Mm-hmm.
Behind the scenes, where is that going? Where is that $100 getting transferred? How does that going through your services and custodians, wallets?
Yep.
Start from the beginning.
Yep. So I think before we discuss that workflow in particular, it's important to understand who the players are in the equation. Like you mentioned, a custodian, and how's that order being filled. And so as of now, in today's regulatory environment, it's very challenging to offer the native crypto experience that a user might get on Coinbase, for example, where once they buy crypto, they can send that crypto to another party. And the main challenge there is the travel rule, where the travel rule basically says that anyone that you're sending crypto to, so a crypto native transaction, so if I buy some Bitcoin and I send it to somebody, I need to KYC that individual that I'm sending it to, or anyone that I receive crypto from. I need to KYC who that's coming from. And the real challenge there is because it's decentralized. That's the whole spirit behind crypto and blockchain, is you can't block those transactions. So if you have someone either accidentally or intentionally sending you crypto from, let's say, from Russia, that's not something that you can block. And so if one of your users receives a crypto deposit from somebody in Russia, how are you going to KYC that person? And that's a real challenge for offering the true hot wallet type of experience, which is why a custodian is essential to the equation. And so it actually is legal right now for banks to be able to custody their own digital assets, but in doing so, banks would need to keep that on their balance sheet. And having a lot of conversations with bankers, it's not something that banks want to do or have the appetite to do now. However, in the future, part of the just to go back to the product real quick, part of the value that we provide is we integrate with best-in-class digital asset custodians that can custody these digital assets on behalf of banks and on behalf of banking customers. But also on our roadmap is we're going to be integrating in an enterprise wallet into our backend to allow banks that want to custody their own digital assets to be able to do so from our platform without having to change technology vendors in order to turn on custody themselves. So
let's go back and make sure everybody understands the definition of a custodian and what the custodian actually is.
Yeah, so a custodian is going to be the party that's legally responsible for holding the crypto on behalf of all of your customers. So when a customer buys crypto from your digital banking environment, they're not actually holding it in their own wallet. It's actually being held in a wallet by whoever that custodian is. And
so technically the custodian owns the crypto, correct? You're almost like leasing the right to it.
Great question. So legally, the end user, the customer, owns the crypto. And whenever they actually agree to the terms and conditions, that's what's displayed to them, that it's being held by a third-party custodian and not the bank itself in most cases.
Okay, great. Thank you.
Yep.
All right, let's move on to, now we've got the custodian.
Yep.
Now, as the bank's customer is purchasing the cryptocurrency, who is fulfilling, let's say that order?
Yep. And this is, this was a really interesting challenge for me and for us here at CryptoFi to unpack whenever we were first getting going. And there's a lot of different options and ways where you can have cryptocurrency order fulfillment, and the orders So I guess let me take a quick step back. So what most people don't realize is that a lot of the exchanges out there, and middle market exchanges, that is, so they're not the ones actually filling all of the orders on the exchange itself. And that's a function of not having enough buyers and sellers to efficiently match orders in every single transaction. So what a lot of the middle market or smaller exchanges do is they'll plug in what's called a market maker, or commonly referred to as a liquidity provider, which provides liquidity and fills all of the orders that are being placed on those exchanges. Now, the bigger exchanges, they don't need these liquidity providers and market makers, but the middle market ones do. And so what a lot of people don't realize is these exchanges a lot of times are really just a middleman between the liquidity provider and the end user, and the exchange is oftentimes marking up whatever price they're getting from the liquidity provider, right?
Yeah, so they're hedging the risk in case the fluctuation changes in between when they sell.
Exactly. And the same thing exists on other platforms as well. And I don't know how the inner workings of other companies like Robinhood and PayPal work exactly, but I do know that Robinhood and PayPal also do not have hot wallets, and they're more than likely plugging in a liquidity provider into their environment, because they're not keeping an inventory of crypto on hand to be able to fill all those orders as they're being placed by their users. And you could probably dig through their S1s and figure that out. But yeah, so I mean that's typically how it works. So there's a third party company that's filling those orders, and what's really important to note is, from my experience, I did a lot of consulting with these sorts of companies prior to starting CryptoFi, and from my experience, and it makes sense why, there's not any sort of contractual language that would obligate a liquidity provider to maintain a max margin or max what's called a spread. So if you hear the term spread, that means it's really the difference between the buy and the sell price, which is how liquidity providers make their money, right? And so if they're not held to any certain margin or any certain spread, then you need to have some flexibility to be able to swap in or swap out your liquidity provider if they're not offering competitive rates. And is that making sense?
Well, I think to bring it back to what bankers are used to, same with stocks going through a broker. If they're purchasing Coca-Cola at $100, well, if they were to buy on Robinhood, maybe it's at a higher price because they're not paying a trade fee. Maybe they're going through somewhere else. So each liquidity provider is going to have a different buy and sell, for what they're going to make it the difference. So yes.
Exactly. And they're all over the place. You mentioned Robinhood. That's a great example, because Robinhood, of course, is not a charity. They are making money on these transactions. And so if you compare the price of crypto on Robinhood to a different platform, it's almost always going to be higher on Robinhood because they're not transparent about their pricing. It's the same thing with crypto ATMs, which is not to get off topic with crypto ATMs, but I know, Ryan, you're very familiar with this space too. And most crypto ATM companies are also not transparent with their fees, and their margins can be as high as 25%. And so if you compare the price at a crypto ATM to a online exchange, for example, it's almost always going to be more competitive at an online exchange. So yeah, sourcing the right liquidity providers is incredibly important, so you're providing the best value to your customers. Because if they log on to your digital banking app, and the first thing that I would do is, because I personally am involved in trading crypto, I'm passionate about it, and I'm going to check the price on what I see on your bank's app or my bank's app versus what I'm currently seeing on the other platforms I'm trading on, right? So if I log into my banking app and I see the price to buy Bitcoin, for example, is higher through my bank than what it is on Coinbase or Crypto.com or Binance or anywhere else, then why would I even transfer my money back from those third-party platforms to my bank to buy crypto? Because the price I'm getting at this third-party provider is still more competitive, right? So,
and that's going to make a difference. If a bank wanted to retain their higher net worth customers and they're looking to purchase 10,000, 20,000, 50,000, that little bit makes a big difference. So, they're going to be looking at all options. They're not going to just accept what your app is telling you. They're going to quote it from several sources.
Exactly.
Uh-huh.
And it's incredibly important to get started off on the right foot as well, because if you're trying to win your customer base's cryptocurrency business and you come out of the gate with the wrong liquidity provider, then, a lot of times you only get one shot with that customer. And if they don't start buying on, through your bank, then they're likely not going to transfer those funds back anytime in the future either. So yeah, we think that's an incredibly important piece to the puzzle, and which is why as well we come to the table pre-integrated with best-in-class liquidity providers. So having the right custodian and the right liquidity provider and the right technology provider are really the three key players to making sure that you're getting the best value for your customers. And so to be clear, CryptoFi is just the technology layer, and the value that we bring is coming pre-integrated with your digital banking provider, the liquidity providers, and the custodians to making turning on the cryptocurrency experience very seamless, both for your administrative staff at the bank and also for your customers at the bank as well. And
now, where are you seeing the greatest risk lies with the bank?
So being able to make sure that, number one, you have the right legal structure in place that can make sure that you're covered now and also in the future. If you're going to be swapping in and out, custodians and liquidity providers, which you inevitably will. Our CFO here was previously CFO at a different crypto company prior to coming to CryptoFi, and he managed a network of liquidity providers. And before we talk about the legal aspects associated with this, one other important piece I forgot to mention for the custodians and the liquidity providers is a lot of the custodians actually have what's called a liquidity aggregation service, where the custodian will manage the liquidity providers on behalf of the bank. So the bank doesn't need to settle with 5, 10 different liquidity providers on a daily basis. And so if the bank's working with a liquidity aggregation solution through a custodian, they can simplify the legal relationship and only face off to a custodian. And then that custodian would in turn ship those orders out to a different liquidity provider for every transaction based on whoever's quoting the best price for each specific transaction. So the bank still gets the benefit of having a network of liquidity providers, but only has to work with a single party in the custodian. So that greatly helps simplify things from the get-go. So does that make sense?
So that's an emphasis where the bank needs to do some deep dive vendor due diligence on the custodian relationship.
Exactly.
Look at their longevity in the industry, look at their financials, see that they're profitable, look that they have working capital, that they're funding. I mean, to me, that seems like the custodians, they need to not be the startup that are burning through revenue month after month. I mean, that needs to be a company that actually has positive earnings and has a future.
Absolutely. Could not be more important. So vendor due diligence is something that we actually assist banks with as well. So we've done our due diligence on all the custodians that we work with, and we can send that over to any bank that is interested in partnering with us. And then of course we encourage them to do their own due diligence outside of that as well. So the other piece that comes into play from a legal aspect is KYC, right? So anytime a user is going to be creating a new crypto account, they need to go through a KYC process, just like they do when they set up a bank account. And part of the value that banks can provide by turning this on is they've already KYC'd the customer whenever they've created their bank account initially. And there's a regulation out there that says that two regulated entities can rely on one another's KYC process. You're laughing. You feel like you've experienced this before.
Yeah, absolutely.
That helps simplify KYC quite a bit, because a lot of customers and ones that especially aren't quite as familiar with crypto and don't have that much trust with some of these third-party platforms that are selling crypto. My dad, for example, he got into crypto just because, I've been very passionate about it. That's all we talk about, over the holidays. And so he finally said he's going to buy some crypto for the first time last year, and he went to go sign up for a Coinbase account and was not comfortable at all giving away his personal information, his IDs, all that to a crypto platform, right? But he trusts his bank, and so he's already done that with his bank, and so KYC does not need to be done for a second time, which is a huge value to the bank and to the bank's customer for offering a crypto solution natively. Now, I will say the custodians do need to reserve the right to recheck KYC periodically. It's usually once a year. And so, a year after, say, turning on a crypto program, there could be issues with a KYC recheck, and then the banking customer may have their crypto account shut down if there's issues with
now,
that.
does your father understand if the value of the crypto he purchased decreased, that wasn't the bank's fault, even though he purchased it through?
Well, he hasn't bought it through a bank yet, so I'm really not sure. That is, brand dilution is arguably one of the biggest risks for banks to be able to adopt crypto. What I tell every banker is they're going to buy it anyway. So whether they buy it from you or someone else, it's going to happen. And I think we've seen the volatility, especially in these last couple months here, even within this last week of recording this on May 31st, by the way.
I was just going to say that. Thank you.
And so, it's a challenge there. But, part of the ways that we try and combat that is through offering robust education, which is another piece of value that we provide. So every piece of education that a user may be getting on a third-party platform today, we've sort of recreated that to offer natively through the bank's digital banking environment as well. So before they buy crypto, the very first time they log on to our widget within the digital banking environment, for example, we hit them right in the face with the education. We ask them where their knowledge level is at with crypto, and we help them understand, number one, the benefits of buying crypto through your bank, and then number two, if they're not familiar with crypto, like what is crypto? Why does it have value? What are the different coins that are out there? Why is Bitcoin interesting? How is Bitcoin different than Ethereum? So on and so forth. So, yeah.
Yeah. Okay, great. So education is at their fingertips.
Yep. So I don't necessarily know that every user, there's obviously going to be situations where customers lose money and they're going to want to call their bank and blame their bank for it. But there again, that's part of the value that we provide too. So we do outsourced customer service, and so we'll field any of those crypto calls that a bank is getting from their customers about this. So,
got it. So, from what I see, some of the market leaders in this space right now, they're banking. It appears that they are their own liquidity providers, and so what I see is they share some of the revenue of the purchase of cryptocurrency with the FI. But what the FI doesn't know is what the price is on the backside. So, banks, you got to ask that question when you're looking to add this product. You cannot just assume that liquidity provider, that one liquidity provider, is going to give the absolute best rate ongoing for your customer. Because there could be arbitrage on the backside of it. The same way with selling of. Bankers are now all familiar with mortgages. They can make money on the points up front, the services, the doc prep, and then when they go to resell it or package it and resell it, then they make percentage on that backside too. It's the same thing with cryptocurrency. You've got the upfront fees, but there is a price. They could have paid way more value of that crypto at that given time because the liquidity provider had a much bigger hedge. So, and that's, you're offering that product later on, there's going to be your high net worth customers are going to see that and they are going to leave because it's not going to be best of class. And I'm all for, if you're going to offer a product, it needs to be best in class for your customers because they will wise up very soon.
Yep. That is absolutely right. And, as I think that's really just the challenge in general with doing due diligence or vetting vendors in a completely new industry. A lot of times bankers don't know the right questions to ask. And so it's not the banker's fault, but there's just a lack of transparency in cryptocurrency order fulfillment, like you're saying. So every banker should ask, show me your current price of Bitcoin, show me your current price of Ethereum if you're offering Ethereum, right? And then compare that to, you can get on Coinbase or Binance or crypto. I mean, there's so many other platforms that you should be comparing that price to. And if that price that you're being quoted from your crypto vendor is not competitive from what you're seeing on these third-party platforms, then you should probably ask the questions at least, why is that? And then consider, is this really the best partner to be going with? And that's not always going to be static as well, and that's something that really important to note. If the price is really competitive now, like great, but what happens if it's not? A year from now, can I use a different liquidity source or a liquidity provider if I'm working with you as a cryptocurrency vendor, right? And so. Those are some important questions I think that bankers should be asking before they actually make a decision on who they work with from crypto.
And as they purchase, how good, customers looking to purchase $1,000 of USD to Bitcoin, and they're comfortable with that purchase price. How quickly do they have to exercise that? This may not be the correct term, but option
to buy that crypto.
Correct.
So I think I'm understanding your question correctly. If I'm not, let me know. But so the price of crypto, the markets are 24/7, 365, as
Yes.
you know. So at least with our platform, the prices update every 5 seconds. And so, by the time they decide that they want to buy Bitcoin or Ethereum or whatever the coin is, they're going to click on that. And then by the time they get to the confirmation screen, likely 5 seconds has gone by. So the price is likely changed. And even when they're sitting on that confirmation screen, at least on our app, they're going to be seeing that price update in real time. So it's really just a function of whenever they click confirm, that order is automatically going to be routed and that price will be honored. Now, the bank doesn't actually settle that transaction until the settlement window closes, which could be the next day, but the user will see that balance reflected in their account immediately. So I don't know if did that answer your question?
Yes, that did. So within that time, as they're looking to purchase, your software is searching through all the liquidity providers set up to give the best price.
Exactly. So, and that's how our integration works. So we take the streaming quotes from the liquidity aggregation source or directly from a liquidity provider. It's a function of whatever the bank, who the bank wants to use. And so if they're using a liquidity aggregation service, which most of them are to start, then we just take the streaming quote from that. And on the back end, that liquidity aggregation service is constantly refreshing the price quotes as well. And they're only advertising the best price that they see from whoever the liquidity provider is at every single 5-second interval, if that makes sense.
Yes. All right. To bring it all together, it looks like there's 4 total parties. You've got the FI, the bank, or the credit union, financial institution. You've got CryptoFi, which is the software service routing everything. You've got liquidity provider and the custodian provider.
Yep. And the liquidity provider can be wrapped up inside of the custodian as well as the liquidity aggregation service, just to simplify the legal nature of everything. So what we typically have is a tri-party agreement with, which is between the bank or the credit union and CryptoFi, and then the custodian that's also providing the liquidity services.
Now, at this time, is just the cold wallet?
Correct. Yes.
Okay.
And you may have seen too, like Robinhood announced like a wait list for their hot wallet, because right now on Robinhood, for example, it's all cold storage as well. And that wait list is a mile long. I'm actually one of the people on that wait list, and I have not gotten any updates in the last, I think, 3 or 4 months since I signed up for it. So I'll be very surprised if they actually launch that this year, like they said they're going to. But yeah, our hot wallet solution will be coming out later in 2023, likely like Q3 or Q4. And there's a lot of regulatory and compliance things that need to catch up before I think any bank would be comfortable offering that. Anyways, I'm curious, Ryan. I mean, you're obviously the CEO of a bank. So how do you think about all that?
I mean, I see banks that are going to the cold wallet because they understand it. Okay, my customer is going to purchase, say, $1,000, and whether it goes up or down, when it off goes back the off ramp, back to the FI, it's coming back to the same bank. So they're just seeing it there and they feel safe. So they can make a little bit of percentage on the buy sell right there. My nature, at some point, I would like customers to be able to have that hot wallet, to be able to leave it there and purchase their goods and services from that wallet. I mean, that is the whole intent. Now, in order to do that, of course, what most bankers don't realize is it is so much more visible and so much more information from the bank side that we can look at as opposed to cash. Once when cash comes into the bank, deposited bank, you have no idea where that cash came from.
Yep.
You're looking at the volume of cash and you can ask your customer where this cash came from, but do they know? Do you, without a doubt, know where it came from? No. But in cryptocurrency, you have a much better insight of where that crypto came from. So if I have a customer using us as an off-ramp, I can run that blockchain and the wallets that it came from through a cipher chase, a chain analysis elliptic, and see if it came from known bad entities. And so you get insight. And then if we have customers that are purchasing crypto through us, you can monitor their wallets and see what they did after the fact. So maybe their activity that they performed at the FI bank level through ACHs, wires, cash, checks, that may not be suspicious of nature. You monitor those transactions, but what they did with their crypto afterwards, that could be suspicious. So, I mean, it's just so much more information that is being provided. So, I mean, if you have the monitor tools, if you have it connected to your AML software, if you understand the ecosystem, I think it's definitely something more embrace. And as regulators actually set back and could see that they have a better view of where transactions are going, money going, they would like it a lot better.
I completely agree. And that's, a macro issue in the industry right now is, you see all these headlines about crypto being used for illicit activities, which is true. It definitely is. But cash has been used for those same illicit activities for since the beginning of mankind, I think. And so, like you're saying, if you can actually track, what addresses that crypto is being sent to, you're going to eventually develop a big picture of who is making legitimate transactions with crypto and who's not. And you mentioned integrating some of the AML vendors into this mix, and there's already companies that are doing this. Like there's some very impressive solutions that are on the market right now from companies like Chainalysis, CipherTrace, Accurant, and so. And a lot of them have like risk scores as well already.
Oh, we actively use their technology, and it's wonderful. The insight that we get is amazing.
Yeah, it really is. And so we're partnered with those too. And so the other product that we have is a corporate treasury management and payments platform to allow banks to be able to accept crypto as a payment for things. The few use cases there in particular, like one, if you're just paying off a loan, doing so with crypto. And then any really large ticket item can also be done with crypto as well, including real estate. Talking to a bank in Utah, actually, that is a big aviation bank, and they have a lot of customers that request to buy, aircrafts with Bitcoin. And so we're plugging in those vendors into that corporate crypto solution as well to be able to manage that. And that's going to be coming Q1 of 2023, which we're pretty excited about. So.
Oh, that's awesome. So individual businesses at the bank level will be able to accept crypto payments through their online banking. Is that the goal?
Yep, both. So the bank itself, and then also the bank's merchants or business banking relationships.
Now, if a business is afraid of, the benefits of a business to be able to accept cryptocurrency for their product or services, they eliminate chargeback rates, from being able to accept credit cards. So, where I see it is large ticket items, 1,000 plus 20,000, 30,000. You don't have to worry about later on down the road fraud or, consumer fraud that customer said, I didn't purchase that. Now you will have to worry about that, somebody else's Bitcoin that was used in that course, but
Yep.
you do eliminate chargebacks by accepting cryptocurrency for your product and services. And, on the banking side, then again, you have another viewpoint of where that cryptocurrency came from. But if they're worried about the market risk fluctuation, what can businesses do to eliminate the fluctuation?
Yep. So that's actually part of our secret sauce that we're pretty excited about building right now. So we have an auto convert feature that we're building in. So anytime that we see a cryptocurrency transaction hit the blockchain, we'll immediately route an order to a liquidity provider to convert that into whatever the native currency is. So US dollars in most cases, right? So for every single transaction, in order to make that happen, for every single transaction, we actually hash a new wallet address for the user. So every transaction has a unique wallet address. So, the bank or the merchant will have a set of custodial addresses that they can accept crypto to. And then, if one of those addresses is like 1234, every single transaction would have a new address hash. So it'd be 12345 or 12346, so on and so forth. And so each transaction, that wallet serves as the unique identifier. So we know, like, Ryan, if you're buying something from me, I know you're the only one that has that specific address. And so once I see a transaction hit the blockchain going to that address, I know it's coming from you, right? So
yeah, and that was the thing early on as we started monitoring customers that were purchasing crypto through or Bitcoin operated companies. You may have an individual and you're like, wait a second, they're sending money to multiple wallets. Well, the Coinbases and the Cash Apps, they're issuing individual wallets each time too when they're accepting it. And it is good practice doing that. So,
yeah, absolutely. So yeah, that's something we're really excited about is offering it more as a payment vehicle. And I think it's still early there, but I think it's a secular trend, and eventually we're going to move to a purely digital world. And so the banks that can adopt that faster are going to put themselves at a better competitive advantage early on. So there's already a lot of people, especially for high ticket items. You can buy a Tesla right now with, actually I don't know if you can. I think they might have turned that off, but you currently can buy high ticket items, like you're saying, with crypto. And if your bank or your merchant and you're not offering that as an option, then you may lose a customer. And so it's important for banks and merchants alike to start thinking about how they can go about accepting crypto as a payment while still managing that risk, because price volatility is a big concern. But if you can automatically convert it, then that's huge. So
this may not be your level of expertise, but you mentioned Web3 and payments earlier. So is there anything that you see like bankers, what they should know or start looking for in relationship to cryptocurrency and Web3 and banking?
So yeah, we've been very heads down on these enterprise crypto use cases. I am not an expert like long-term with Web3. However, I think starting to adopt the solutions that we're talking about now and getting the right compliance measures in place so you can take advantage of a lot of the new value that Web3 is going to unlock is really the building blocks that we're trying to get in place right now. I still think it's still early. So a lot of these advanced use cases and ways to take advantage of Web3 are still being developed currently. And so if you're getting the core, buy, sell, hold, and like payments use cases in place and having the right infrastructure and compliance measures built around that, you're going to be really well positioned to compete much more effectively in the next few years as that continues to evolve.
Yeah, thank you for listening to the Paper Podcast today. If you like what you hear, please like and subscribe and share. I really enjoyed talking to Kian today. There are things, bankers, you may have fear of missing out on the cryptocurrency, but, don't always go look to see, don't go to the easiest provider that you see every bank searching on to. Really dig in, look who the vendors are. If you're going to offer these services, you want to offer the best services to your customers. Please, add some comments. Let me know if there's any deeper dives in this you want to hear, any questions. Please comment, send me an email, find me. Thanks. Have a great day.